First half of the year is over and everybody's still wanting to know if and when we will have a housing crash. In this video, that's what we will talk about. I'll tell you when it will happen, if it does happen. Hey guys, it's Mac Rogers, broker owner of Albert Rogers Realty here in Castro Valley, California, in the lovely East Bay of San Francisco. If this is your first time on this channel, welcome. This channel is all about living in the East Bay, what it's like to live here, how much does it cost to live here. If you're looking to move here or move out of here, we can and we will love to help you out. I also give tips, advice, hacks for home buyers and home sellers, and I also do monthly real estate market updates just like this one. If we can help you out, give us a call, text, email, smoke signals, pigeon carriers, however you want to reach us, we would love to help you out. So a couple of weeks ago, I made a video addressing what Susi Orman posted on her Facebook page. I will put a link on the video up here. Watch that video and see my complete rebuttal or response to her post. Let me quickly summarize it here and let's talk about what the market is doing, where it's heading, and when that dreaded crash is going to happen. So stick until the end to find out. So Susi Orman basically said on her post not to buy real estate until the later part of the year. In her example, she said that if you buy a home right now that's worth $300,000, that could very well be worth $150,000 in a matter of months. That's a 50% decline. Now, she's saying this and basing this advice on the current forbearance mortgages that is happening right now. She believes that once this forbearance comes due, there will be a flood of homes coming into the market, thereby depressing home prices. She said this is exactly what happened in 2007, 2008. Now, if you watch my video, I presented my argument as to why this is not the same and why what she is saying won't happen yet. I'm not going to go through that in this video, but the bottom line is I presented a number of statistic and economic factors to show that what she is saying is wrong, which I still stand by that analysis. So why am I making this video and have I changed my mind? Well, there's a small part of me that is starting to believe that this crash that everyone is talking about and waiting for could really happen. I mean, I believed before that there was a likelihood that there might be a crash. Anything's possible, right? However, it was always far-fetched, and here's why. I'll give you my 2020 market forecast and what to expect, and then go on as to why I have that nagging feeling that there may indeed be a crash. We will talk about the economic recovery, unemployment, prices, sales, and then go to the crash. First, let's start with this. Is the economy finally showing signs of recovery? 91% of economists that were surveyed agreed that the economic recovery is already underway, and 83% is believing that the recovery is going to be a quick recovery, a V-shaped recovery like this. The Wall Street Journal has this to say. The first stage of the recovery looks V-shaped. After bottoming out in April, economic activity has continued to rise into early June. According to a range of private data, an L-shaped recovery in which activity stays depressed now looks remote. And while the overall recovery might not end up V, it may also be less feeble than many had feared. Furthermore, the journal also states that a strong economic recovery depends on effective and sustained containment of COVID-19. Economists said in the latest monthly survey by the Wall Street Journal, with 91% of business and academic economists agreeing somewhat or strongly that the economic recovery depends on containing the pandemic. So let's talk about the unemployment numbers and what it will look like in the coming months and the years to come. The consensus for June was we were going to add around 3 million jobs. That number was blown out of the water. The numbers that came in was actually closer to 5 million. There's certainly a lot of fear being sown on both sides of the political aisle, but take a look at the actual unemployment numbers versus that of the Great Depression. We are clearly nowhere near those numbers. Now, this is not to undermine the people that are losing jobs. Certainly, those are people, not just numbers. Here's another look at the unemployment numbers compared to the number of people filing for unemployment benefits. The difference between the blue and the orange are the people that are going back to work. Here's another graph that shows the breakdown of the age groups that are returning to the workforce. A majority of them are the ones that are potential buyers entering the real estate market. Again, per the Wall Street Journal, U.S. job growth surged last month, underscoring the economy's capacity for a quick rebound if businesses continue to reopen and consumers regain confidence. A recent coronavirus spike, however, could undermine trends captured in the latest job report. This is why most economists are calling for a V-shaped recovery or a swoosh type of recovery, because there is more depth but less length in the recovery process. It's like a bounce, and while a lot of people are trying to correlate unemployment to housing, which if you think about it, it kind of makes sense, right? More people out of jobs means less people that can afford to buy or keep their current homes. However, if you look at the unemployment and housing relationship, it's almost an inverse relationship. Which brings us back to why are people thinking that there will be a crash? Somehow, people are equating what we are going through right now with the last recession. During that last recession, it was actually housing that caused the recession. One reason that we got into so much trouble was the lax underwriting that we had. But now, compared to the last time, it's totally different. Now it's harder to get a loan than before. There's also the demand side of the equation. If I've shown this next graph before, and it basically shows you how demand is just going through the roof, far more than before we started this coronavirus. Because of this demand, this is what is driving the home prices. As a matter of fact, this is what one economist have to say about this. The housing recovery has been nothing short of remarkable. The expectation was that housing would be crushed. It was for about 2 months, and then it came roaring back. This housing recovery index shows you that while we are not back to where we were before when you factor in demand, price, supply, and time on the market, we are certainly well on our way. Then there's equity. When real estate market crashed, there were a lot of homeowners that did not have equity in their homes. So there was no incentive for them to keep their homes. This time around, 77% of homeowners have at least 20% equity in their homes. Let's talk about home prices and see what the experts are saying where we are headed. Fannie Mae had this to say about home prices. Recent home purchase measures have continued to show remarkable strength, leading us to revise upward our home sales forecast, particularly over the third quarter. Similarly, we bumped our expectations for home price growth and purchase mortgage originations. Check out this graph. 7 out of 9 that were surveyed is projecting an increase in home prices in the next 12 months. One predicts that it will be slightly down, and one big outlier, CoreLogic. Now, CoreLogic is a big player in the real estate and mortgage industry. CoreLogic is forecasting that we will be down by as much as 6.6% next year. When CoreLogic was asked why their projection was total opposite of everyone else, they said that it had something to do with the unemployment numbers and the economy moving forward. They're basically more bearish than everyone else. They believe that the unemployment numbers will be on the higher side of projections, thus creating pressure on homeowners who might lose their jobs and in turn will need to sell their homes. As we continue down this path, here's another thing worth considering that will affect pricing and demand, and we are starting to see already transpire. People are starting to move out of metro areas. People are moving back to be closer to their families. John Burns Consulting has this to say about this new phenomenon. As states, cities, and counties around the country slowly reopen, we predict the Great American Move. For safety reasons, financial prospects, life change improvements, personal comfort, and employment, we expect a surge in household and business relocations over the next few months that will provide new strategic opportunities for real estate markets. Now, I've seen this firsthand already. I have a number of clients that have done just this. They moved out of the city. They moved back to where they were originally from to be closer to their families. Now, some of them have even started asking their companies to relocate them to places where they have other headquarters. Usually, it's a less expensive place than the Bay Area. So when is the crash? Well, if it happens, it's most likely not going to happen this year, and this is why. Simply because the government, the feds, the banks, they are doing everything to make sure that we don't have a repeat of 2007 and 2008. The stimulus 2.0, and forbearance. All these measures will most likely mean that no big market activity happens this year. So does this mean that it happens next year? Well, it could very well be. Maybe around this time next year. Just take a look at forbearance. This is everyone's poster child for the crash right now. Everybody loves to talk about what happens after forbearance. So let's try to play this out. Say for example, I take forbearance. I asked my lender for a 3-month forbearance. It started in April, now I miss April, May, June, and July comes around and still nothing, right? Now I go back to my lender and ask for another 3 months and they grant it. Then another 3 months is over and still the same situation. So I asked this time around for 6 months and they gave it to me. So now I'm in 12 months forbearance, right? Now let's fast forward to April 2021. I'm out of a job, I can't pay my mortgage, I have to sell the property. Now multiply this by thousands of other homeowners like me and you start to see the foundation weakening. Then you have people that want to get out of the metro areas. You now have additional sellers coming into the market as well. Add to that the workers that will be allowed to continue working from home or from anywhere. Most of them probably, again, fleeing the metro areas. Take this another step further with renters. Renters that can't pay their rent or renters that are moving as well will further put pressure on real estate prices. Landlords that can't get tenants will then have to put their properties on the market. Now, what about commercial real estate? If enough workers are working remotely, will they have empty office buildings? Think of the impact on that. That's more jobs that will be lost because there's no building to service, no workers to spend money on the food and other services around that area. Look, the virus, that will be contained. Even if we see another spike, tourism, travel, that will all come back. After 9/11, everybody was so afraid to fly, but we all got back on the plane. A lot more security checks, but still, if we truly become a nation where a majority of the workforce will work from home, wherever that may be, then most likely the real estate landscape will change. The way things move, it might be sooner than next summer. I think the East Bay and the rest of the Bay Area in general has a lot of exposure here. There are a lot of workers that are in tech. Like I said earlier, I've seen a couple of my clients already move out of the Bay Area and had asked for transfers to places like Austin, Texas or Portland, Oregon. And we are just in the beginning stages. I think the more likely scenario is we see prices flattening or even declining a little bit. An outright crash is still highly unlikely considering all the factors we have going for us. However, it is there and something that we need to be aware of. If you want to know more about the real estate market in the East Bay, check out our other videos. I would love to hear what you think about them. Comments, thoughts, feedback below, please.